Market movements. There are always buyers and sellers in the market. When there are more buyers, the market moves up and is said to be bullish. When there are more sellers, the market moves down and is said to be bearish. Support and resistance should only be part of your trading plan. Resistance is always above, the market presses up to resistance. Support is always below, the market falls down into support. The market in this chart is pressing against resistance and falling. It's also finding support and rising. People expect there to be strong price reaction at the support and resistance level, but support and resistance levels do not always show reaction. You may set alerts at important support and resistance levels, and then when or if the market reaches those levels, you start to watch and implement the next phase of your trading plan. You very often find that support, once it fails, is then used as resistance, and resistance, once it fails, is used often as support. Support becoming resistance. When the market reached this level, there were suddenly more sellers than buyers, and the market began to fall. Buyers stopped finding value at this level and they stopped buying. Also, buyers who have positions started closing their position and taking profit, causing the market to fall further. There are now more sellers than buyers. People do not want to buy at this level, so price continues to fall. Here, at the previous support, the market continues to fall, but some people will buy at this point anyway, expecting the market to make a bullish move once again. They find value at this support level. At this point, buyers start taking over. There are enough of them that prices start to climb. The market reaches what was support and is now resistance. The last time the market tried to use this level as support, it failed. The buyers now begin to take profit or break even if bought at support. Sellers step in expecting the move lower. Some people who bought at 1 have held onto the position also. When the market returns to this level at 2, which is now resistance, they close their positions at break even, happy they haven't suffered a loss. Resistance becoming support. This was determined as a level of resistance. People stopped finding value here and the market subsequently fell off. When the market reached this level, it continued higher and broke above the resistance area. Buyers no longer want to buy here. This would be buying the highs right after the market has pressed through the resistance. Buyers who bought at 1 and held through the resistance are taking profits at 2. The market then begins to fall once again. Buyers are aware that there is now value above this level because buyers have already bought the market above there and forced it higher. This is resistance becoming support. Sellers who have sold here are now happy to exit at break even instead of a loss. The buyers are more prominent and the market presses higher. It's important to realize that this is how markets move. You will rarely see a market simply pressing high without sellers stepping in. You will also rarely see a market falling without buyers stepping in. Not only is support and resistance a great way to help you identify areas to watch for trades, but the market movement themselves are also very important whilst in a trade. Lots of beginners panic as soon as the market starts to move against them, and this has a detrimental impact on their profitability. Let us say you bought at the yellow circle. It's easy to then panic when the market begins to stall and move against you. Lots of beginners would exit at any of the blue circles. However, the market was still bullish. Selling is no different. If you entered at the yellow circle and exited through panic at the first sign of buyers, you might exit at one of the blue circles, but the market still had a long way to go. If you trade like this, exiting at the first sign of a trade moving against you, it will become extremely difficult to be a profitable trader. It's very important to understand how markets move and to build the ability to remain calm when in trades. It is the job of your trading plan to determine where you exit trades. Moreover, if you have the perfect trading plan but you don't follow it and instead exit as soon as the market moves against you, you are no better than someone with no trading plan at all.